Hello and welcome to an all-new episode of Deciphered right here on the CryptoCast Network. Thank you, ladies and gentlemen, so much for joining us again on another beautiful evening here to talk crypto. We have our links up here, sharing them. We have the CryptoCast.net CryptoCast.network website where we have our YouTube, Twitter, iTunes, and Instagram links there. And we also have our merchandise up there if you guys want to support the channel. And as always, we are sharing our QR code at the bottom for donations, as this is a community-supported YouTube channel. And we thank you guys so much for your feedback and for your donations. And we're still doing the Programming with Bitcoin.com interactive 2-day workshop. We'll be teaching C# developers how to work with Bitcoin. That'll be taught by both the creator of the and Bitcoin library himself, Nicolas Doyer, and myself. And really, this is great for a lot of C# developers. I mean, some of the C# development that I've seen really kind of take off recently is something in like the Unity development for video games. C# developers can really take advantage of this course for that, to be able to start integrating Bitcoin into their video games and other things like that. But C# touches everything, not just video games. So it's a really, really great language to start interacting with Bitcoin. And we're going to be taking this course across the country right now. We're going to be going to San Francisco October 13th and Seattle November 3rd. So with that aside, let's stop the screen share, get right into the show, ladies and gentlemen. Got our special guest here. We're going to be talking to Mr. Stephan Livera from the Stephan Livera podcast. Stephan, how are you doing this evening?
I'm great. Thanks for having me on, Vortex. Always a pleasure to come on your channel.
Absolutely, man. Yeah, we've had you, of course, on here a couple times. Got you on the Bitcoin News Show, and we're always thankful for your information that you give out there. Really great stuff, and really like the the Austrian economics point of view. And so that's kind of why we're here tonight. We want to talk about Austrian economics a little bit, and really the goal of this particular podcast tonight is to kind of let blockchain developers know why they should care about Austrian economics, or at least get some of the foundations of Austrian economics and why that's important to them. So before we get into all that good stuff, Stephan, let me just ask you, maybe you can share with the audience, how did you get started with economics in the first place, specifically Austrian economics?
Yeah, it's a funny story. I was like 14 or 15 and I was hanging out on IRC channels, and this guy linked me to some Mises daily articles on Mises.org. And at first when I got into that, I was like, no, that doesn't really what is this? What is all this crazy kind of stuff? But then over time, it sort of dawned on me that actually some of this stuff made a lot more sense to me than some of the things I was learning in high school at that time. So then that was what really kicked off what's almost, this is like a lifetime study of Austrian economics, along the side of having like your mainstream career in that. What I've really just done over time is just read a lot of Austrian economics, whether that's articles by guys like Bob Murphy, or whether that's, reading books or watching talks online, and then sort of enhancing the understanding in terms of economics, which in my view is a more sound way of thinking about economic problems and understanding the kind of, the society we live in, and understanding the trade-offs that are inherent in just about anything, any action that we take. There is some kind of trade-off. And so those were all part of my kind of overarching kind of journey. I'm 30 now, so I've been into this stuff for probably 15 years or something like that. So it's just been a long time just reading a lot of different arguments and trying to understand them also in terms of how would an Austrian respond on this point against this particular school, say against a Chicago school person, or against, say, a Keynesian person, or the relations between, say, Austrian economics and maybe there are some interactions between what we might call other schools of economics, like, say, the public choice school of economics. So that would really be most of that's kind of how I first got into some Austrian economics. Today, in terms of how I would describe myself, yes, I'm a libertarian. I'm informed, obviously, by Austrian economics. I am more on the side of, say, full reserve banking within the Austrian kind of debate. There are others who believe more in like a free market fractional reserve banking school, but I side more on the full reserve side. So yeah, I'd say that they're kind of the key. Yeah, and I suppose in terms of key influences, I think obviously Ludwig von Mises is a big influence. Murray Rothbard is a big influence. Guido Hülsmann, he's one of the modern day Austrian monetary scholars. I think he has written a lot of fantastic stuff. Who else? Hans Hermann Hoppe is fantastic. I like Karl Menger, some of his work, on the origins of money. And obviously from the modern day kind of, crypto worlds, guys like Safedine Amoos, Vijay Boyapati, Pierre Rochard, Michael Goldstein, I think these are some of the guys who are kind of what we might call as the modern day, crypto Austrians, or whatever you want to call it. I think these are some of the guys who have really best applied Austrian economics into this new world of cryptocurrency and Bitcoin.
Absolutely great information on there, Stefan. So then, you spoke about it a little bit, but let me just ask you, what is kind of the main difference in the Austrian economics school of thought and the school of theory versus all of the other ones? You mentioned a couple like Chicago and things like that. Maybe you could tell us all
Sure.
for briefly just what are the main differences really from Austrian economics and the rest of the schools?
Yeah, so it's funny because going back hundreds of years, there was what was called classical economics, like British classical economics. And then around the kind of late 1800s, I think it was around the 1870s or so, Carl Menger and some other people came up with this new theory in terms of, it was called the marginal revolution. And at that time, that was the time that Austrian economics kind of started with Carl Menger. And really, Austrian economics was pretty much the mainstream economics at that, over those next few decades. But then over time, it sort of fell a little bit out of favor in terms of government and politicians. So in terms of the basics of how would you categorize the different ways of thinking, one crucial way is methodological subjectivism and also methodological individualism, right? So this is that theory that individuals act. You and I, we have human preferences and we take action to try and, make the world or make our living scenario more closer to that preference. And in understanding that individual preference and going right down to the individual, you can get a better view and a better understanding of things rather than a more sort of Keynesian understanding, which might be more about the aggregate values. So a Keynesian might talk in terms of things like, the gross output and the actual output and the potential output. And if I did this multiplier on the economy, then that's how much I can change the aggregate output. Whereas an Austrian will think of it more like, no, hold on, that's not precise enough. If you want to get more precise, we need to understand what's happening at each individual level. And what that does also is Austrians have a improved theory of capital compared to other schools of economics. So rather than viewing capital as, this is just the machinery of society, it's just one big blob, actually Austrians will view that more like there is a certain structure to that capital. Pieces need to fit in a certain way, right? And one example, if you're interested, I've heard Bob Murphy use this example in a debate before. Imagine, we all went to sleep one night and these like magic garden gnomes go around and move all the equipment, right? So let's say like the mechanic equipment gets moved and now it's in like the lawnmower guy's shed and the lawnmower guy's gear is in the mechanic's shed. Well, the economy considered as an aggregate, well, all the equipment is still there, but would we be as productive? No. It matters where those pieces of equipment are. And then the other thing that is really kind of layered in an Austrian sense is this concept of time preference. So this concept of stages of production. So I would say they're some of the key differences to understand from an Austrian point of view.
Very interesting. I mean, it does see. So I guess you could say like the Austrian school is sort of more of the results and actions and choices of individuals. Is kind of trying to aggregate everything together. Does that sound right?
Yes. So the Austrian school does kind of, in some senses, talk about aggregates. Obviously, we talk about society, right? But in terms of explanatory power, we have to think of things first from the individual action. And that is then what enables us to kind of make deductive conclusions about the way society grows and the way society does not grow. So part of that comes into the Austrian theory around how it is actually savings that enable capital accumulation, which then in turn enables us to lengthen our structure of production. So that's a bit of a technical term, but let me go into the basics on that a little bit. So if you buy something to produce right now, that's a consumer good. If you're buying something to produce, a consumer good, think of that as a capital good. And then it's not just that there's, it's not just capital goods are one homogeneous thing. There are many, many types, and they come in different stages, right? So if you want to make, you might have to make, before you can make the cake, you need to have the oven. Before you can make the oven, you got to make the metal or whatever, right? Like, so there's the different stages of all these things. And through understanding that stage basis of production and how interest rates coordinate that and prices coordinate that, that is how a kind of a capitalist understanding of the economy can sort of come to light. Now, I suppose in terms of what would be more relevant for a Bitcoin or a blockchain, protocol developer, they would want to think in terms of what makes a good money, right? And I would say the key thing to appreciate from the Austrian understanding is, where did we go wrong in the past? What happened in the past? Now, one way you can think about that is how gold was the money of the world for thousands of years. It was the money selected by the market. It's not that the government came out and said, oh, you must use gold. It was the money chosen through spontaneous interactions. And over time, people chose the best money, right? And so if you read Safeteen's book, The Bitcoin Standard, that kind of explains how it's almost like it's a game of hard monies, and the hardest money wins, right? And how do you make your money the hardest? Well, certain things play into that. So things like, how hard is it to change? How scarce is it? What is the supply ratio, or what is the what he refers to as the stock to flow ratio? So the stock of gold versus, say, the 1.5 or 2% new gold that gets mined every year, right? And so you understand it through that frame. And he explains how in the past, it was more just about storing your value through space and time. But over the last, let's say in the 1900s, a lot of that was also about monetary intervention. And so the key things to understand there are around certain centralization pressures that gold faced, or just gold had, because in order to transfer gold, country to country, that's a very costly endeavor. You needed security, you needed, obviously, you need ships and trucks and all this to move gold. Whereas with Bitcoin, it's not like that. And so when you understand it in that way, that helps you appreciate that there are certain components of the system that must be maintained decentralized. Now, don't take that the wrong way. It doesn't mean just, decentralize everything, because not everything can be decentralized, or not everything should be. But the argument in this case is a crypto Austrian understanding of Bitcoin might well be that you need to decentralize the validation of transactions. And so that is where, people who are aware of the recent history of the last year or two, or couple years actually, in Bitcoin, where there was a bit of a debate. And one way to frame that and understand that between, say, the Bcash big blocker side and the, kind of Bitcoin side, or Bitcoin core, we'll call a small blocker side, it was about ease of transaction versus ease of validation. And in the kind of, at least in my view, or in most of the kind of crypto Austrians' view, ease of validation is much, much more important, because transaction can just be done on other layers. And that comes to this understanding of Bitcoin as the base layer, and other layers on top of that as the payment network on top of the settlement layer. But the crucial thing there is how decentralized is that underlying layer. So I think one thing to understand from an economic point of view then is, what are the trade-offs associated with keeping that ease of validation?
Well, and before we get into that, because I do have a couple, I want to kind of take it in a little bit of order, but that's really great information so far. So, I mean, like I said, so you basically are saying, the growth of the main part of Austrian economics really is the growth of an economy, through investment and capital formation, right? Instead of like just pure consumption. And that's, I think, what's really important as well. And so, what I want to get into now is basically, let me ask you this: how has Bitcoin itself? Because I want to bring it back to Bitcoin too. How has Bitcoin slash blockchain basically like affected your understanding of money in general? How has it sort of has it changed your ideas at all, or has it altered anything that you've come to learn so far through Austrian economics?
Yeah, it's a
Or
good
has it, or
question.
maybe has it proved some things right as well? But how has it altered your thinking versus Bitcoin being successful now versus not knowing about Bitcoin?
In my view, Bitcoin is helping show that there are strong tendencies towards one best money. Now, that is something that we see even in this whole, quote unquote crypto ecosystem, that many of the exchanges, they, if they take one crypto, it's Bitcoin, right? If they take more, it's Bitcoin and all these other ones. And so you can see even just in this little kind of economy that there's still a strong tendency towards one best money. And in our view, in that kind of crypto Austrian view I was mentioning earlier, there is a very strong tendency towards one best money. And there's a good reason for that. It's because barter is costly, right? So there are various reasons why barter is costly. It's, because things are not as divisible. So, a silly example might be, let's say you've got cows, but I make telescopes. And I can't easily cut up my telescope into 1,000th and give you that, right? And they may not be equally transferable, right? So it just causes this massive cost. And our view in the crypto Austrian understanding is that the world we live in now, the money we have now, is a historical aberration. It is only because of government intervention and things like legal tender laws and taxation laws demanding payment within a certain currency that have kind of put us into this aberration time of history. Whereas if you look back thousands of years, gold was money. So that's another way to understand it.
Makes sense. Makes a lot of sense. Okay, so then let's go this route then, because we did touch on it a little bit, but I kind of want to get into a little bit more here. So why do you think is it so important that we maybe think of Bitcoin first as a store of value more than a medium of exchange? Because we all want to think of it as a medium of exchange as well. I mean, this really is a store of value with a payment network attached to it, which is of course amazing. But why is it important, really, from an Austrian point of view, a monetary economics point of view, important more to think about Bitcoin first as a store of value before a medium of exchange?
Yeah, so this is a fantastic point. And for anyone who has not read, I would highly recommend you read Shelling Out by Nick Szabo. That touches on precisely this topic. And so now Nick Szabo is a polymath. He has gone and understood so many different things and kind of weaved them together. And I think he wrote Shelling Out in the early 2000s, 2002, if I remember correctly. And one of the points he makes in that is that money started as a collectible, and it then evolved more in terms of things like long-term value storage and also things like intergenerational hand-me-downs. So it was things like it was intergenerational wealth hand down, or let's say two tribes were intermarrying and one of them had to pay the other a dowry. It was about not just like I'm buying coffees, it's I'm transferring you 40 cows or whatever, right? And so he explains that as proto money. And so he does really well at kind of explaining that, in a sense, it's not going to just start as lots of little payments. In our view, it's going to start more like a collectible, and then a store of value, then a medium of exchange, and then finally a unit of account for the globe. And so some other people who would be good to listen to or read some of their work on this, you look up Vijay Boyapati's The Bullish Case for Bitcoin, and that's where he helps outline some of that. And in that, he also refers back to, funnily enough, William Stanley Jevons, who was one of the, in the marginal revolution back in the 1870s, there were three guys who sort of around the same time came to the same idea around, actually, the important thing is the unit on the margin. So we should think on the margin. And that was one of the key insights. And he himself also wrote about this concept that money tends to proceed in things like a collectible, then a store of value, then a medium of exchange, and so on. Now, in our modern day world, I think for me personally, what I see as the two very strong narratives. First, number one strong narrative is long-term store of value, obviously. But I also see some value in this secondary narrative, which is unstoppable payments. So this idea of being able to, donate to WikiLeaks, or you can buy stuff off Alex Jones because, whatever, these guys have been banned off PayPal, or you can send it to a country that hasn't been, doesn't have the same PayPal and credit card infrastructure that you and I have in our, kind of modern Western rich nations.
Makes sense. Yeah, it's kind of interesting to see some of these other chains like Ethereum sort of value this decentralized computation idea, or this, this unstoppable code idea. I mean, the idea is kind of cool, but the fact of the reality is we've never had a problem really of Amazon censoring our computation, right? Or Intel censoring our computation. Now, of course, we have problems of illegal spying and the NSA and all that lovely stuff built into our chips and everything. And of course, we would like to see that fixed and maybe decentralized just by making it more open source and things like that, with more open source BIOSes and more open source internal components of the computer. But at the end of the day, we just never, as a species, as as a culture, as a society, seen too much censorship of our computation. So that's why I want to bring that up, because the Ethereum developers, that's a big thing for them, and I just don't see that as a problem. What I do see as a problem, and what we've seen, as you brought up with WikiLeaks, is a problem of decentralized payment. Now, that's something that does get censored like crazy all the time, and has been through the centuries of, dating back thousands of years. There's been censorship of money, right? It's always sort of been there, even back when the kings were minting money, like all the way back then, there was censorship of money. Money's always been sort of censored, but the ability to compute, to go out and do something, I mean, that's never really been too censored. So I want to just bring that point up to see how to make sure that that's understood, that really the importance of decentralized and censorship resistance comes mostly into this payment, this idea of being able to censor your money by either making sure that you can't pay somebody, or by confiscating it, right? And so, of course, Bitcoin gives us this first unconfiscatable money, which is just profound to think about. But and then another point that I want to bring up, you said, is how it's important to understand these various phases of a crypto network. So, and maybe crypto networks will follow this as money. But what we've seen in the past from the money, as you've outlined, is that first something becomes a collectible, then a store of value, then a medium of exchange, then a unit of account. And it seems to me that some of these people might not understand that, and so they're building these chains where they're thinking that something like maybe BCH, that maybe just all we need is medium of exchange, and that'll derive value. Because of course Roger Ver likes to give out the view that, hey, the dollar is a store of value. How many of you use the dollar as a store of value? And of course, like, a bunch of people raise their hand because they're regular people that get paid every 2 weeks in the paycheck and their local fiat. They don't really understand. But I want to make sure that that's impressed upon here, is that it's not, in fact, just ability to just transfer around things that's going to give it value, right? First, it has to become a collectible to make you want to have it. There's got to be some unique properties that make you want to have this thing. And then when enough people have this thing, then you can start viewing it as valuable. So, maybe I want to collect more of these things, and maybe I want to save in some of these things. And then now, when everybody has saving in these things, then we can, of course, start trading them as a medium of exchange. And then when it becomes ubiquitous, then of course the unit of account starts kicking in. So that's really interesting. Maybe if you want to just do a quick comment on that before we go into the next question.
Yeah, sure. I think, so I think, we've touched on that whole thing of stage growth of money. And I think it's an interesting one as well. So one thing to point out there, as Murray Rothbard said, the defining thing of money is its role as a medium of exchange. Everything else flows from that. However, the way I would explain it is, it's kind of like, yes, it's true, the defining element of money is it's a medium of exchange, but the way it manifests will appear in those stages we were saying. Because the other thing is, even, you look at the way many Bitcoiners think about it now, they don't necessarily, they might spend a small amount, or they might spend Bitcoins if they have to for living expenses. But the way I think of it, it's, if you truly believe that this is, if you're a monetary maximalist who believes that Bitcoin is going to millions, why would you spend any large proportion of your Bitcoins today unless you absolutely had to? And that's the way I think about that. And
that's what we've seen. That's what we've seen in the wild too, Stephan. Like, we've seen people getting paid in Bitcoin, and we've seen their employees not use that Bitcoin for food or for things like paying for lunch, right? Because that lunch could have been like 5 times more money.
Exactly.
That $15 lunch could have been $50 just a few days from now.
Yeah, exactly. And then the other one, just to hit, is that point you mentioned, a great point as well, is around how difficult Bitcoin is to confiscate. So the fact that people can, and there are all manner of different ways of storing your private keys, so people can do things like encrypt them and put them in a locker somewhere, or use multi-signature and have different pieces in different vaults, or some with a Bitcoin bank and some, pieces elsewhere, and that as a storage mechanism helps preserve the decentralization of the system. And if you look at the way gold got centralized, part of that is because all the gold got stored in one place, so not all of it, but obviously it just got centralized into certain areas that were just easy for a government to assert its control. And as soon as that happens, then that begins that process of that kind of erosion, right? And so if you look at historically the way gold got stored in like Fort Knox, and other countries would store their gold there, and then Germany famously wanted to get their gold back and so on, but they had to go through a process to get that back, right? And so another kind of way to think about it is it's monetary defensive technology. People can run their own node and they can store their own keys in their own different ways, right? Not all the same way. Maybe some people have on a Trezor, some people have Ledger, some people do Glacier protocol, some people go to Casa and they use the 3 or 5 multi-signature. These are all different ways that you can choose the model that works best for you.
Very true, very true. So great points. Let's go on to the next question. And it's kind of more of a general question before we get into like the specific properties of Bitcoin that we think is important from an Austrian point of view. Maybe you can say, maybe you can answer this like, in general, sort of what does Bitcoin look like through an Austrian economist mind? Because right now, from a developer point of view, like it looks like, right, it looks like this crypto network that's built on this Bitcoin protocol that we use that we access with a full node that creates this network that we can then access and create transactions from and do cryptography. But what I want to know, like from your point of view, from an Austrian point of view, what does Bitcoin look like? How would you describe it? And then we'll get into a little bit more of the properties.
Yeah, so this is an interesting one. I'm not as kind of expert on the categorizations, but there are, in the Austrian kind of way of thinking about money, probably if you look back to something like Theory of Money and Credit by Mises, he does talk through various different forms of money. Now, it might in some ways kind of be closest to like a commodity. That's probably how I would, sort of think, like similar to gold, right? That's kind of how I would look at it. But another way to think about it is around substitutability, right? So people can talk about things like, is it a perfect substitute, right? So now this is another concept that I picked up from Guido Hulsmann's book, The Ethics of Money Production. Now, one point he talks about there was how legal tender laws by the government, another monetary intervention, helped government paper money kind of assert itself over what was, physical gold, right? So because the legal tender law came in and said, hey guys, you must treat each of these tickets to gold as though they were a piece of gold, or, whatever, right? Then that helps the government assert its kind of, that kind of helps the government put its claws into what would have been the free market money. And so that's another way to kind of to think about Bitcoin. And then so, like, interestingly enough, then that also plays into things like Bitcoin's fungibility, right? So there's work being done on that. But what might happen if there is not enough work done in terms of privacy, and you look at guys like, the Zero Link framework, Wasabi Wallet, Samurai, so on, if Bitcoin does kind of be seen by people as, tainted, well, then each Bitcoin will not be seen as a perfect substitute for another Bitcoin, or 100 Satoshis might be different from, this other guy's 100 Satoshis. So that is an important aspect to try to maintain. But at the same time, it's important to also maintain the strictness of the supply. So yeah, there are a few points. But I think to answer your question, I would think of it at kind of like this really hard commodity. That's kind of how I would think of it, but just like a digital version.
And so speaking of hard commodity, right, we want to get into that a little bit too, about, what makes Bitcoin this hard commodity that developers need to pay attention to if they ever want to make either a money or make either something that interacts with money, so that they can understand what makes Bitcoin important, so that they can maybe start thinking along the correct lines of what to develop as a company, right? As what to develop, what kind of idea. So because remember, remember there was a whole bunch of companies in the early Bitcoin days that thought they understood Bitcoin, right? And they thought they understood it as like this network of cheap space with, oh man, cheap transactions, we can do cheap microtransactions, we can revolutionize the credit card industry and things like that. They just didn't quite understand Bitcoin. So, they went after basically payments and microtransactions and tipping and things like that. So, something that that Bitcoin was only good at for a certain phase. Now, of course, at least on the base layer. Now, of course, we have multiple layer solutions that can handle that no problem all day long. They just didn't see that back then, and so I think it's important to understand what makes Bitcoin Bitcoin, so for these developers, so that they can think of companies that will ultimately benefit Bitcoin, not just now, but in the long term as well. And it becomes difficult because Bitcoin continues to change and evolve over time. So we're all just kind of trying to evolve. And if you think you understand Bitcoin now, you don't, because it'll just be evolved in a few more years and it'll be something else, sort of. So it gets difficult. So and on that fungibility issue, that's really important too. That is still, Bitcoin is still a bit of an experiment. The fungibility problem is an issue still, but of course everybody is very, very, very aware of this. There are already many proposed ideas, and as you mentioned, a couple of privacy ideas that are coming down the line. Schnorr signatures, coin joins, all sorts of the good stuff like that. Even stonewalling, which is a technique that Samurai Wallet uses to prevent blockchain analysis. So this stuff is coming, but it's just important to understand why. So let's start maybe with a few of these points. I want to go through a few of them. So the first thing is, from an Austrian economist talking to a developer, like, what would you say the importance of this fixed supply limit is? Like, what would you say?
Yeah, oh, absolutely. So I think a big part of the reason why people have invested now, Austrians believe in subjective valuation of things, but part of that is you and I, when we buy things, if we're going to try and buy it as money, then it's crucial that we think it's scarce. Right now, money is a little bit different. Money is a sui generis good, and I think Mises might have described it as that. Whereas in any other thing, generally you want more goods, right? More housing, more computers, more everything. But with money, you don't necessarily want more, and actually, a fixed supply might just be totally fine. So, from that point of view, then in terms of enticing people to invest into Bitcoin, that is a big factor, right? I think for me personally, that was a big factor when I wanted to, buy some Bitcoins. A big factor was, hey, there will never be more than 21 million. And even for me, like, let's say, if I had to think of what scenarios, Bitcoin fail and whatever, if Bitcoin supply changed away from 21 million, I'd be out. I'd probably just say, no, well, we failed. I'm sorry, but I think that is a crucial thing. So from I suppose from a developer point of view, I would say, yeah, look, really pay attention to the 21 million limit. And then also the next implication is things like, Rusty Russell's article, The 3 Economic Eras of Bitcoin. So in that article, he talks about how basically the point is, in say 10 or 12 years-ish, we might start to hit a certain level of pressure in terms of ecosystem, right? So the miners in the ecosystem and potentially Bitcoin payment processors might have an incentive to try to put in inflation. And the way I view this is, you've got to understand the Austrian economics to help inoculate and understand why inflationism is so devastating and so, deleterious to society. And so this this will kind of help people understand, why the investors of Bitcoin would likely not go to such a chain. So I personally think if that sort of scenario were to occur, we would probably see something similar to what we saw with the No 2X campaign. So it would basically be a bunch of the economic majority holders of Bitcoin saying, no, you guys want a fork to put in inflation? Well, no, I'm not going to go with that fork, and I'm gonna split my coins, and I'm going to dump the chain that I don't like, or they might do things like how Bitfinex and maybe one or two other exchanges had kind of like a B1X token and a B2X token, and then they would actually trade at different prices, and so that is another example of a way where if you're not aware of kind of how this system would play out and aware of the way forks can happen and forks kind of get determined, well, then you might get wrecked if you kind of think everyone is just going to go along with that. But I think in fairness, I think people are learning. So people have learned, okay, no 2x happened. Okay, what's the lesson? Well, it means I need to get consensus before I kind of make some kind of change like that. And basically, if you don't instantly win, you've pretty much, you don't have a chance, because the kind of the reflexivity of it just kind of implies that even just a slight edge would just kind of maximize and just kind of, then it'll just, and now we've got the same situation now where, say, Bcash is like under 0.01 or 0.1 rather. So anyone who tries it without getting the consensus first, that's probably the likely fate. So I think from a key, Austrian point of view, I think the scarcity of the money is very, very important. And I think, it's just an understanding of what Safety explains with that stock to flow ratio and around what makes a money hard and then what makes it more likely to win out against other monies.
Awesome. So let's talk a little bit then about the next step here, which is the proof of work mining, because proof of work is often misunderstood, and it's a difficult thing to get your head wrapped around, because again, we've never had a decentralized consensus type of network like this before. And so I want to talk a little bit, maybe again, from an Austrian point of view, if you're talking to a developer, how does the proof of work mining play into it? How do you see it? Why is it so important? Because just briefly, I think that the distribution of Bitcoin is the most fair that we've ever had in any monetary system ever in the history of mankind, with the ability to be able to have these coins needing to be sold, right? They need to be sold by the miners because it costs money to create that coin. So they have to eventually sell some of it. So there's no way to like just 100% always hoard all of that Bitcoin. The Bitcoin must be distributed. So maybe from an economist point of view, what does that look like, or what does that maybe reference in the past, or how can we understand it and frame it? And again, from your point of view, from an Austrian point of view, why is that important for a developer to really grasp?
Yeah, no, fantastic question. I think there's a lot to unpack. In terms of the key people to go and read, or to just kind of understand, one guy on that is Dan Held. He did a good article, and I know you interviewed him earlier, Vortex. Another good guy I've seen write an explanation on that was Hugo Hanoi on Twitter. He's written a great series in terms of Medium articles about proof of work. Now, the key thing, I think economically, it's similar to the same people who made an argument that, oh, hey, the gold standard, it's a massive waste of money. Think about all the amount of time spent mining gold. But that is not the true comparison. The true comparison is the monetary standard that we would have in the absence of a gold standard. And in the absence of a gold standard or some kind of hard money standard, well, then we start having fiat money, inflation, warfare, welfare state, these kinds of massive, massive costs that society bears, right? And it's there's so many people to kind of read on this point. I think Nick Szabo is obviously a key person to read on this as well. So he talks about this concept of trust minimization and social scalability. So if you understand from the Nick Szabo or Szaboian view, it's that how would I say it?
Szaboian view. I'm sorry, but that's just awesome. I'm now going to start using that. I prescribe to the Szaboian view.
Yeah. If you're a Szaboian, right? If you believe in, if you understand from his point of view, it's that, nowadays computing technology has gotten so good that we can use what kind of looks wasteful from a computer point of view, but is not wasteful from a social point of view. I think that's probably one way to characterize his understanding on that. And I think,
sorry to interrupt, but because people see those mines, right? They see those mines that are long all the way down to the size of a football field. You can't even see the ends. And so right away, the average person looks at that and like, wow, what a waste of electricity. They see that right away. But you're saying, of course, it's not just, for example, digging a ditch. It has huge social implications, positive social implications.
Exactly. And so that is probably one way to think about that. And the other thing is, going back to that kind of Austrian economics understanding, and one of the common books, the first book that we will give to someone who's a newbie to Austrian economics is we'll say Economics in One Lesson by Henry Hazlitt. And the crucial lesson from that book is about the seen and the unseen, right? So just because something is not an explicit cost, you don't necessarily see that, right? So the classic kind of example is the broken window example. So the idea with that is you're in this town and overnight a window gets broken of the baker, right? And people are gathering together the next day and trying to figure out, oh, what happened? And then someone says, oh, well, you know what? Maybe it's a good thing because now you will induce more spending. This baker will go and have to spend to fix the window. However, there's a problem with that. The problem is there's an unseen cost, because if the window were never broken, then that 200k satoshis or whatever he would have spent to fix that window might have then gone for him to make bread equipment, right? So in the same way, in this case, the unseen cost, or kind of the unseen almost benefit, is that yes, society has to spend some amount of its energy or production on making money, but it's best that be kept, the lowest. And what you have to do is consider the overarching cost. So the overarching cost of the system is, okay, yes, there's all this hashing power, all this electricity spent on Bitcoin proof of work, but that is what helps us not have this massive cost of, government welfare, and all of these other pieces of infrastructure. The other interesting article to read on this is this article by Roger Garrison. So he's an Austrian economist. I think it's called The True Cost of a Gold Standard. And so in that, he basically makes kind of similar arguments, because similar arguments were made about gold. They would say, oh, gold, it's a barbarous relic. It's terrible. Look how much they're spending on it.
A lot of the Silicon Valley prescribes to this, where they're like, oh, gold is just a rock that people dig up. Why do we have to spend all this money digging up and moving this rock around?
Yeah, right. So that is a very specific point as well. So on that, I would look up this article by Hansam and Hopper, and it's called On the Yield of Money Held, or something like that. And the point there in that case, and this is again using that methodological individualist understanding, and to understand why we hold money. We hold money because of future uncertainty. If we knew exactly what was going to happen, well, I might go and buy bonds that pay off at exactly that date, or a term deposit that pays off at exactly this date, or I might buy those things right now. But in reality, we hold money because, I don't know what will happen tomorrow. Maybe I'll break my leg and I need to pay for an emergency surgery or whatever, right? But the point is, that is why we hold money. So what looks like it is a waste of just, oh, look, all this gold sitting in the vault, ultimately it's actually not a waste, because you have to understand why people hold money in the first place. And then I think from a technical point of view, some of the key points that I would make in terms of the whole proof of work, proof of stake thing is understand that if people don't have to incur a big cost to acquire the coins or kind of sit on the coins in a proof of stake model, then the system just won't maintain that same level of security. Whereas in the proof of work world, they have to, you kind of prove that really they had to spend that to get to mine those blocks. And in doing so, that helps everyone in the whole system have more comfort in the scarcity and the difficulty of Bitcoin mining, right? Because if it was super easy, everyone would do it, right? But it's hard. So it's not. So it's not everyone doing it.
Great points. The seen and unseen costs. I love it. That's really interesting. People need to, I think really people need to grasp the severity and importance of that, but also the nuance of it, because it is so, so subtle. It's so subtle, the importance of it. So it might be hard to catch. So very important. And again, so Stephan, just loving all the links and or all of the books and recommended readings that you're shouting out to. Awesome stuff, guys. Like you really need to look into everything that Stephan is saying. This podcast is sort of going to serve as a recording to send to all the developers that we want to see. So we want to say, hey guys, if you really want to know the importance of Austrian economics, like check out this video, and all of the books and readings that Stephan has put out there, you guys need to check out. They're all very important to the understanding of this. And again, Stephan has shouted out just a dozen plus references at least of books and papers and readings that you guys need to check out. So just don't throw that away. Don't hand that away. It's very, very important, guys. So make sure that you understand that. He has thrown out a bunch of great links. So now let's get into this other property. So far we spoke about the fixed supply limit and the proof of work mining. Let's talk a little bit about the full nodes and decentralization now of this, because again, this gets lost with people when we're talking about the importance of sound money, especially when it applies to a cryptocurrency, a crypto network. When you're looking at these types of things, you see other chains like Ethereum and BCH not care so much about needing to run a full node. You see them almost not even knowing the importance of a full node or really what a full node is. All they do is they go to Infura and pay for their service, pay for their node, spin it up, connect to it, and they're done. So maybe we can talk a little bit about the importance of that and why, from an Austrian point of view, talking to a developer, why is the ability to run your own full node so important? The ability to validate your own transactions, the ability to validate your own version of what you decide Bitcoin is, what the importance of that from an Austrian point of view. So what do you think of that?
Sure. Okay. So I would say it's maybe this point is not exactly Austrian, but it's more just maybe it sort of is. Let me explain. So part of what Safedine and some of the other guys are saying is that this is like a monetary defensive technology. And if you can't easily access it, well, then it gets centralized. And if it gets centralized, and this is, to some extent, some of the stuff even people like Caitlin Long have been referring to, this risk of fractional reserve of Bitcoins. So if people are not cognizant of keeping control over their own private keys, if people are not maintaining some kind of ability to withdraw the Bitcoins, then there's a centralization risk. Now, in the free market, one way to think about it is like, if you thought, okay, this dodgy bank you thought, oh, hey, it's a dodgy bank, I'm going to go do a bank run. That is kind of the way people would sort of stop that, stop fractional reserve practices. But what happened is if you've read The Ethics of Money Production, what sort of happened is that point earlier around the government saying these pieces of paper or these pieces of plastic are legal tender. Every merchant in the land must accept them as money. Then that is how one way the government kind of got its claws into the system and then changed it and co-opted it. And so the crucial thing there then is to keep an eye on keeping the validation of transactions easy, such that anybody can run a full node and do a transaction out of their node. Or, in the future, that may be, more like Lightning, being able to do Lightning transactions. And the other thing is just around, maybe even if we do move to a semi-trusted model, I think that means the focus of Bitcoiners and developers and so on needs to be on keeping exchanges accountable. And one way might be through doing things like proof of reserves. That's one example that exchanges could use to try and prove, hey, we're legit. We say we've got 200 million Satoshis, and yep, here's our balance saying, yep, we've got 200 million Satoshis, or whatever, however many Bitcoins you've got. So there are some exchanges that I know in the past who did try to take this focus. And I know there are some, I think Voltoro is one example where they try to provide what they call glass books and try to sort of show that. That is something, I would encourage. I think part of this is understanding where we went wrong before. It's like that saying, those who don't know history are doomed to repeat it, right? So we have to understand that there have been attempts made to make money before. So famously, PayPal or Liberty Reserve or eGold, right? All these things just got shut down because they were centralized. And so that is kind of one way of emphasizing the importance of keeping the overarching decentralization of the system such that people can easily validate the full set of transactions which in turn gives them that comfort in the overarching system, in the scarcity of that system. Because if people lose that comfort in the overarching, limit, the 21 million limit, I think the whole thing would just be gone at that point. At that point, I don't know if I would still be into Bitcoin if we lost that. So I think, basically they're the key points. I think it's just around keeping the ease of validation, basically.
Yep. And again, ease of validation, the importance to validate without a third party. The fact that your transaction has gone through, not only your transaction, but the amount of value that you have, right? The amount of Bitcoin you actually have. Obviously with traditional precious metals, you have to go through all of these different verification methods, which, as you mentioned, just takes huge amounts of time. And if anything is ever maybe reintroduced into the system, it has to be re-put through all of those processes. For example, for gold, there's just layer after layer after layer after layer after layer of crazy amounts of verification and processes and things like that. So that's what, Trace Mayer talks about this all the time. He describes, all the time he describes the processes of Bitcoin in terms of gold, in terms of precious metal. So, he says that, Bitcoin is basically smelted, or, every 10 minutes, right? There's new Bitcoin mined. I forget some of the terms he uses, but it's just fantastic. Everybody needs to check out Trace Mayer, the Bitcoin Knowledge podcast. He has a great stuff. And again, he's an Austrian economist as well, lawyer as well. And, he describes, again, Bitcoin in all of these economic terms, and specifically around gold, because that's really what he really views this as is a digital gold. And he, of course, Trace Mayer also coined all the 7 network effects for Bitcoin and things like that. Financialization, of course, being one of them, as we briefly touched on with Caitlin Long. But they're just the network effect seems to just keep on coming. So this has been a great conversation, Stephan. I think we can probably end it about here. We've got about an hour, lots and lots of important stuff. I guess my favorite thing to take away from this is, Bitcoin being a monetary defensive technology. Like, that's a really great way to describe Bitcoin, maybe some of these other chains, but specifically for sure Bitcoin. So, if you're a developer and you want to be either building applications that interact with Bitcoin, with libraries like NBitcoin in C#, or if you want to actually work at the protocol level, it's just really going to be important for you to understand the reason why Bitcoin exists in the first place. The whole reason why we're here, guys. Check out the Genesis block. I mean, if you read back through, I really encourage developers also to read back through all of on the Satoshi Nakamoto Institute website. They have all of his forum posts and all of these mailing lists, and it's just clear. You can see the intent. If you look to the source, go to the source, guys. When you go to the source, the intent is very, very clear from Bitcoin. So very, very interesting. Maybe, I do kind of have maybe one last question, just a little bit, because we'll talk just talking about central banks, because a big part about Bitcoin is sort of creating a monetary system outside of the state, and our current monetary traditional system right now is really ran by the central banking system. So real quick, what do you think? What do you think a world looks like in the future where Bitcoin succeeds? Does Bitcoin take over the central banking system, and everybody just starts providing Bitcoin central banks, and then we'll have regular banks for lending, and what does the Federal Reserve look like at that point? What does the future look like of central banking with Bitcoin if Bitcoin succeeds?
Yeah, so first of all, I think it's going to take decades to play out, and in that time, we will see almost this kind of parallel economy of Bitcoin come up, and people will just use Bitcoin in this parallel system, and it will become almost like the cash economy, right? So because there's a bit of a war on cash, I think naturally people will start to use crypto. And because, again, there is reason to use the one best crypto, it will be a Bitcoin denominated world, right? So for example, people might, get their plumber, and, that plumber might have in the past, 20 years ago, he might have said, oh, hey, if you give me $80 in cash, instead of charging you $90. Same kind of thing. People might do that with Bitcoin, right? So they might open up their phone and say, oh, hey, I've got a Lightning invoice, pay me on this. I'm not necessarily saying, everyone should go out and do tax evasion, but it happens, right? This is what I think is going to happen. I'm just describing what I think is the likely outcome.
So you're saying, just simply saying, of course, that taxation will become much more difficult for central banks and for governments that run central banking policy. Yeah. Okay.
Precisely. Yeah. I think governments may move to something like a property tax instead of, income and stuff. They may have to move to that because it's a bit easier for them to kind of say, oh, well, you live here, we'll tax you for that. Anyway, Back to your question. I see it like there will be no, in the Bitcoin monetary standard future, there will be no Fed, there'll be no IMF, there'll be no BIS, Bank of International Settlements, there'll be none of these kind of organizations. They just won't be funded, because who would fund them? Who would voluntarily pay to these things? So ultimately, we will see a future with banking, right? There will be Bitcoin banks, and they will do that role of credit intermediation, but there will be no central banks. And so that is the way I view it. We'll have different models for ownership of Bitcoin. There'll be some people who just literally want to do everything on layer one, and they keep their own full node. And then there'll be other people who just use a retail Bitcoin bank, and their wallet will, they'll have their phone, and they'll have, whatever and in the bank will handle all the stuff in the background, right? The Lightning network, the Bitcoin, whatever else comes on top, the channel management, all that in the background. You don't have to worry about that. You'll just, on your balance, you see, oh, I've got, I've got 1 million Satoshis in my wallet or whatever. And that's kind of the future I see, but it will take decades to get there. And it's not just gonna, it's not.
Well, it's not going to happen overnight. That's for sure.
Yeah,
Everybody wants it to happen right now, of course,
Exactly, yeah. And I think the other thing is central banks, I think they're not, I agree with Safety on this point. I think they are not the type of people to understand the need for Bitcoin, and they'll be some of the last to buy into Bitcoin. Whereas other people will have more of a incentive and more of a reason to get into Bitcoin before them. So I think there may be, like, along the way, there may be people who try things like, oh, hey, we'll have, whatever, the US dollar backed by a certain amount of Bitcoin and certain fractional backing of Bitcoin. But in the end, I think everyone's just going to be moving to Satoshis, right? It'll just be eventually, that's kind of in my view, the monetary maximalist position, is that everything will just be in Satoshis eventually. And we'll just be talking in like, oh, pay me 200 sats for that coffee or whatever. So that's kind of if this all succeeds, that's kind of how I see it playing out.
Hashtag set the standard, people. Satoshis is the standard.
That's right.
That's how it should be. I hate to do it because it's going to put us over an hour, Stephan, but I got one more final question.
Yeah, go.
And this kind of steers away from, I still want to make this video, the video to point to for developers, but one last question, like what is Bitcoin, what does lending then look like in the future, 10, 20 years from now when Bitcoin is successful? What does that look like? Is that something on just layer two? What does that look like from a Bitcoin bank point of view? And if Bitcoin succeeds, so we're talking, 2024, 2028, 2030, whatever, what does lending look like in the future if Bitcoin wins?
Yeah, this is a big one. It's hard to predict, right? On the whole, though, we currently live in a society where debt is cheap. So I would suggest we will see slightly more equity funding than debt funding currently. Now, there are other reasons for that as well. So with debt funding, you get tax deductions. So part of that is driven by a government. But if I were to speculate on what it might be, let's say someone so I'm talking in a full reserve banking world here, people would have more of a clear distinction between what is held on demand, as in, this is my money held with you on storage, you're not allowed to lend that out. And then there would be other money that I've given to you that's like a term deposit. So let's say Vortex Bank, right? And with Vortex Bank, I keep, some money, I keep 1 million Satoshis with you on demand deposit. But I also say, oh, Vortex, you're offering me some interest. Okay, I'll give you another 1 million Satoshis, and that will be held in the kind of Vortex, bank term deposit product. And you'll pay me, whatever, 10% interest. So I get back 1.1 million Satoshis in 1 year's time. And in the meantime, you would do that role of credit intermediation, right? So that is the role played by banks. They assess the credit worthiness of customers or of people who want a loan, and they take they borrow from other people. So currently they do that through doing things like issuing bonds and whatever, and taking retail customer deposits. So in the same way that they do that now, they would do that. I think just in the overarching system, we would probably see there'd be a tendency for less debt than what we have now, is my speculation.
Okay, makes sense. So very, very great. More equity funding than debt funding, basically. So that's
we don't know. We don't know if it'll be more equity. It's just like less than we currently have. It might still be a lot of debt funding. It's hard to say. It depends on a lot of things, like what people's time preference is, how willing, there's a lot of there's so many moving pieces there. So
Exactly. Yeah. And that's why I had the question, because you can't really answer that in just a quick 2-minute, right? It gets really hairy really fast. So thank you so much, Stephan, for trying and I think we can end it there, guys. So so much. Thank you so much, Stephan. I learned so much. I hope everybody learned a bunch here tonight. I had a great time on the show. If you guys like the show, please share out the show. We really appreciate it. If you guys give us a thumbs up. If you guys are new to the channel, then please hit the subscribe button. Click the bell so you guys know when we do a new show. And of course, we have super chat, so you guys can tip us on there. We've had a couple of tips on the super chat already tonight, so thank you guys so much. We had some great conversation in the chat. Actually, we were talking about Lightning Network and the possibility of centralization there. Of course, I tried to tell people that more than likely we're not going to have too much centralization with Lightning. So that was a great discussion in there. And again, guys, we learned so much from Stephan. So thank you so much. We have a brand new Bitcoin news show tomorrow, of course, Sunday at noon, every Sunday at 12 p.m. Pacific. And then on Monday, we'll be having a brand new Bitcoin Matters show from, of course, the one and only Beauty On. That's going to be a great show. Looking forward to that. That'll be released on Monday. So lots of stuff to come, guys. Next week's actually going to be a pretty busy week because there's going to be a conference. And plus, I have to have a bunch of shows lined up and scheduled. So thanks so much, everybody, for joining. We really appreciate it. And until next time, guys, just keep on talking Bitcoin. We'll talk to you later. Bye-bye.